Hello and welcome to our 2024 market update. It's been a great year to start, so let's get right into it. Max, who are we?
I'm Max Westerman.
I'm Victor
We
Connor.
got Josh behind the computer working everything, making sure it's going well. And then we got Karen, Amy, and the rest of the team.
All right. So, you know our underlying thesis 90% of the things you worry about never happen. We make observations, not predictions. Oh, Occam's razor, the simplest explanation is the best. And Economics 101. So, let's get right to it. Number one, here's the markets as of today.
All right, the markets as of today, the Dow is up 3.8%. If you look at the utilities, that's what's getting hammered pretty hard right now. It is down 5%. Interesting though, right now, Uber just moved into the transportation average. So we'll see what happens there. That stock's been pretty hot as of recently.
It should be driving the transportation average.
The S&P is doing really well right now. It's up over 6.5%. And then the NASDAQ is up over 6.75%.
You know, it's interesting right now that we got the NASDAQ and the S&P right around each other. And this 6%, I want you to think of this. Right now, we're only 6 or 7 weeks into the year. Mm-hmm. So that is a great start.
And the big thing is, go back, the S&P crossed over the 5,000 mark.
A record. Okay. I'll do this when you do the Dow Jones Industrial Average. The trend is pretty obvious if you look on the far right. You see the 20 DMA, daily moving average, the 50, and the 200. Right now, all three of them are confirming a strong uptrend. And then now the S&P 500.
The S&P 500, as you can tell, correlates with the Dow in a strong uptrend. And then you can see on the far right-hand side, there's a breakout point. So it looks like we're taking another leg up, and we'll see where it goes from here.
So from a technical point of view, it's a very strong year. And finally, our leader, NASDAQ.
NASDAQ, it's the same corresponds to what the Dow and the S&P were both saying. It looks like another breakout, and so another strong year possibly.
We got a great year to begin. Okay, I want to make a point on this. This is a 2020 illustration of time in the market versus timing. Last year, I want you to look at all those boxes. I'll start with the second one. There's a 2,900 point drop. Okay, 8%. Then a 1,000 point drop. Then a 3,300 point drop. Every single time there was a big drop and the market not only recovered, it went on to new highs. In order to get the sell when it goes down, buy when it goes back up, right? You had to make 6 correct buy, sell, actually sell, buy decisions. If, however, you had left it alone, if you left it alone, Max, what would you have ended up?
Almost up 14%. Pretty good year.
Yes. So is it timing the market or time in the market?
Time in the market is what it is.
That's it. And we're bringing this up, and you'll see why in a minute as well. All right. Before we do some key terms, before we look at some returns, I want to talk for a minute about some very key terms because people get these confused all the time. Nominal rate of return, it's just a number. You were up 10%, 5%, 7%. All economists and academics use the real rate of return. And it's because the real rate of return adjusts for what?
Inflation, fees, taxes, all of that.
And the expression is the real rate of return talks to your purchasing power. Mm-hmm. So that's the most important one. Now, this next slide we got from our recent event with Jeremy Siegel. So I want you to watch this. These are from 1802 to 2023. And that seems like an awful long period, 200 years, but there really hasn't been a change. Watch this. Stocks. If you put $1 in stocks in 1802, what's it worth now?
2.1 million. Almost 2.2 million. That's a pretty good return.
That's it. Yeah, I was going to say a darn good return, exactly. Now watch this. The second one behind it, bonds. So instead of 2,000,001, you got how much?
$1,463.
Wait, are they missing some zeros? And then we go to Treasury bills, which are like 1-year CDs.
237 whole dollars. That's a lot of money.
Yeah. And then this one, we get a lot of discussion. Shouldn't I buy gold? If you put $1 in gold in 1802 today in purchasing power, $4.18. And here is the one that just blows me away. Remember, these are real rates of return adjusted after inflation. If you had $1, stuffed it in your mattress, and brought it out today, that dollar would buy 3.9 cents.
Point 039.
0.03, like 4 cents.
4 cents.
Wow.
Wow.
So
You lose money.
You'd lose
A lot of money.
Oh, absolutely. But I still have my dollar.
You still have your
It just doesn't buy anything. Can you buy anything for 4 cents?
I don't even think you can buy a gumball.
That's what I was thinking. Okay. So you see those two lines coming up. That trend has been long term. If you look at stocks, the red, you can see some of the declines. Without going through, the 2000 to 03.com bubble is there. The real estate crisis is there. But through all of those, from World War I, World War II, Korea, assassination of Kennedy, crash of 87, anything you can think of, these are still the numbers. Stocks overwhelmingly outperformed in real purchasing powers everything else in there. You want to add anything, or are we good?
I mean, just the major thing, the next closest thing, you off $1, you would have had $1,400 versus $2 million. I mean, that's not even a comparison.
Wow, that's not even a comparison. Okay, so what do we have next? The stocks, remember, when you see 6.3, these are real rates of return adjusted for inflation. So if inflation was 5%, the stocks earned 11. If inflation was 15%, the stocks earned 21. Stocks, real rate of inflation. Real rate of return, 6.8. Bonds, half as much. Bills, treasury bills, 2.5%. Gold, 0.6. And how'd the dollar do?
The dismal dollar was down 1.4%.
I like that, the dismal dollar. Okay. So let's take a look now at what we're looking at going forward this year. You've already seen we had a good start. We're going to flip back and forth for each one just so you see everything. Right now, the Fed has signaled the peak in the interest rate cycle. Historically, bull markets begin after the Fed interest cycle ends. Guess where we are now? The cycle just ended.
Inflation reports confirm disinflationary trends in many commodities. As we've shown the charts before, we had lumber, we had oil, we had coffee and wheat, and they all showed downward trends, especially lumber. Lumber was the biggest one.
Well, you know what I'm going to say. I haven't seen a downward trend at Dunkin' Donuts coffee.
You should bring it up to them.
Exactly. I'm telling you, last week we were doing a seminar, and Josh brought up, he goes to Starbucks. And I forgot, what do you buy at Starbucks, Josh? You can say it, we'll pick it up.
I get a nitro brew with a double shot of espresso.
A nitro brew with a double shot of espresso. And it costs how much?
Costs like $8.
$8. I get coffee with cream and sugar for $2.04.
That's what you can do with 4 cents. You just
There
need
we go.
$200.
Okay. The recent market moves, what you've seen the first couple weeks, is partially because the Fed has indicated clearly we see progress on inflation and they're willing to lower rates.
The 2024 election wildcard. 50 major Democratic countries, including the U.S., have significant leadership elections in 2024. This will likely result in increased volatility. You'll start to notice this around the summer when we get closer to the election in November.
And here's interesting. 1928 to 2016, the average annual return for the S&P 500 during an election year, a little over 11.25%. Promises to be a good year. How often did that come up?
There have been 23 elections since the S&P 500 index began. 19 of the 23 years, 83% provided positive performance.
So the reason we're building this up, I want you to notice from the top, we just finished the rate cycle going up. It's now leveled off. Inflation's under control. We've got some elections, and in those 83% of the time, we've had up markets. Everything is falling together for this to be a good year. The other point that Max made, it's going to be a good year, but because we have so many elections, will it be volatile?
It'll be very volatile.
So, and we're going to get back to that in a minute. Again,
The cross-current election year cycles increased government spending to strengthen the economy, yet U.S. debt levels make increased spending quite risky.
so you're going to have a lot of discussion go back. And remember, the bottom line of all of this, the 2024 outlook is very favorable based on historical standards, the conclusion of the Fed's actions, but the election's going to add some volatility.
Well, if you go back to the last point, Vic, or one before the cross-current one, the
Well-
administration will want to spend more money, which will increase the economy and grow the economy because they want to stay. They want to stay the administration.
Yeah, they want, money buys votes. As much as I hate to say it, it's true. Okay, you want to do the economy just briefly?
All right, the economy. The economy just keeps going. America's economy kept growing last quarter. It would be a very hard for it not to keep growing in the current one.
So we have a strong economy.
We got a
Backing this all
strong
up.
economy.
Whoops. Housing prices. What are happening now with housing prices?
Housing prices, price growth accelerated in November, but right now we're also seeing I think we're seeing a little bit of a slowdown in housing prices. If you go on Zillow, if you go on Redfin, you go look at the housing prices are starting to come down, which is good for inflation because housing makes up about 40% of the inflation.
And then finally, in the services sector, we're seeing a lot more being spent on services. And Max, you had a good point last week. A lot of the spending now, instead of hard goods, they're buying what? Experiences. They want to go. Did you go to a restaurant this weekend?
Yes.
So you went out and you bought an experience.
I bought an experience, yes.
Okay. I'm sorry.
The millennial generation is a big experience-driven generation. We'd rather spend our money on experiences versus things.
All right. By the way, you're hearing a lot in the news these days about AI. What is AI? Oh, you want to ask me?
What is
Artificial intelligence. And artificial intelligence is the next wave in the computing industry. Candidly, I believe it will be as big as the internet. Does it have some problems? Absolutely, yes.
Does that help with a bull market run?
Absolutely, because what it does, it's a good and bad. The good, will it help productivity across the board in corporate America? Absolutely, yes. And as a result of that, do we use AI?
We do use AI.
And how?
We use it for tax planning and estate planning. And what we can do is we take your tax return, we scan it into our computer, our AI software looks through it and identifies issues of where you can save money in taxes and help your estate as well.
If you'd like to have that done for you, send in a PDF copy of your tax return. We'll scan it, and then we work with your accountant to look for any missed opportunities, etc. And then finally, one thing we're going to run through tremendously. This pattern has repeated itself over and over since 1926. Average length of a bear market.
11 months.
Average length of a bull market.
6.5 years.
So
wow.
you're telling me 1 to 6.5?
Yeah, wow.
And
I'd rather be in a bear market or a bull market.
Me too. Yeah, absolutely. It's a lot easier to be in a bull market. Okay. Go ahead and do this one.
All right, so all professional athletes have teams and they have coaches. Why? To develop a discipline and remove emotion. I'm sure all of you who played sports, everybody had a coach, right? We're your coaches. We tell you what's happening, how you can improve, where you can improve. But this goes right to the point. It's a Dalbar study, 20 years annualized return of asset classes from 1999 to 2019. Average market return, 6%, 6.1%. The average investor, 2%. The difference, what, Victor?
Emotions. And this is why we had, where'd I go? That chart earlier. Individuals try to time the market. And when they time the market, this is what they get. Mm-hmm. Okay? Because you got to have a right sell and a right buy. A right sell and a right buy. Okay? It's a great idea, but we've learned over well, it's what?
And who's the best investor?
We are. Oh.
Warren Buffett, and what does he say?
And Warren Buffett says, I wish the market was open only twice a year, once to buy, once to sell.
Exactly. And what Victor's just about to say, it's about time in the market, not timing the market. That's the most important thing, and that's where we help the investor the
You
most.
know, I'm going to throw something out. Every once in a while, I'll get a client say, well, Victor, wouldn't I just be better buying the S&P 500 and leaving it alone rather than having to hire a professional advisor? And the answer is yes, if you would do that. People don't do that. All of a sudden, the market goes down. They go, oh, my God, I got to do something.
Yeah.
It's a natural reaction. So they sell out. And then it goes back up. And I can tell you from experience, when it goes back up, they go, oh, I'm not going to get back in. It was cheaper. I'll wait till it goes back down again. And they never do it. Academically, it's a great idea. The reality is right in front of you, 1.9% versus over 6%. Wow. By the way, here's the benefits of a professional advisor. If you work with professional advisors, here's what we give you. Run down what we give them.
All right, there's 5 main things: accountability, customized programs, expert guidance and support, progress tracking, quarterly reports, semi-annual reports, and social interaction. Those are the 5 main things we give.
That's what a professional advisor does. And let me tell you something. Who is that guy on the left?
He's going to be in the Honda Classic this year.
Oh, is he?
Yeah,
I've
Rory
heard-
McIlroy.
Oh, and who's the old guy, excuse me, the more senior person on the right?
That's his coach.
Wait a minute, I thought he knew how to play golf.
Just a little bit, but he needs guidance. He needs expert guidance.
And what's that little picture down below?
That's taken in Hollywood, Florida, where he's been his coach since the age 9.
So if Rory can take advantage and benefit from a professional advisor, you've got to understand the concept. And we all get back to this overwhelmingly. It's time in the market, not timing. We're bringing this up because since this is an election years bring what?
Volatility in the market.
There's going to be chances like you see here, the market will take a big drop and you'll say, oh my God, should I get out? And should they get out, Max?
No, it's time in the market, not timing the market.
Absolutely. Okay. Estate planning, these are the other demand workshops. Estate planning, how to protect your kids, taxes and retirement, managing traps, navigating Social Security, and savvy IRA planning. So,
Thank you for joining us today, and remember, we're here to look it out for you.